Atlanta, Florida, Puerto. Hey, Bowtie Nation! Thank you for being here for another Beer Money Sunday. Love getting together with you at 2 p.m. Eastern, 11 a.m. Pacific time, and wherever you're at in the world. Just talking to some of the good people in the chat here. Where are you from? Where are you tuning in from? Again, thank you for being here. Love having these little, face-to-face live conversations with everybody. Gets me charged and energized for this next week. Great video for you today. One that I get asked about a lot, so I wanted to make that the theme of today's video. Really, when should you sell a stock? And it's one of the most common questions I get, not just for stock traders either, but really a critical question, even for you longer-term investors. You must have, whenever you buy a stock or an investment, you need to have a sell price in mind and a reason to sell before you buy. And really what that's going to do is it's going to take the stress out of that investment, right? It's going to take, no matter what you see in the news about the stock or where the price goes, you're going to have a plan for it, and you're not going to have to be watching it every day. And you're going to be able to get out, frankly, in front of some of the hard stuff that might happen to that stock. So really excited to talk to you about that today. And then of course, after we cover those 5 reasons to sell a stock, then we'll have some question and answer and really get the conversation going. So I see a lot of people here in the chat there. Thank you for being here again. See a question already about Zynex in the news. A couple of the stocks that I've been following and a couple of the big names have taken a hit just this last week. I know Zynex did. There was a couple other. Fastly has also taken a pretty big hit, and we could talk more about this in the question and answer part. But just a big part of this penny stock and these growth stock names is understand that not all of these are going to be huge winners. Fastly, even after the 26% drop that it took, I think Friday, it's still up something like 500% since recommending it last November. So still doing really well. But with a lot of these penny stock names that we talk about on the channel and a lot of the other growth stocks, your intent here isn't to make every single pick a winner. It's just not going to happen, okay? In my days as a venture capital analyst, we used to have upwards of 40 to 50% of the picks, so even 4 out of 10 of the companies that we invested in go completely broke. Maybe some of those would return some of the money after a liquidation or after a sell, but 4 or 5 out of 10 aren't gonna do anything for you. What you want though, in looking for these high growth names, these penny stock and high risk names, is you get those 3 to 5 that are then going to go on to be 5 and 10 and even 20 times your investment. So what that does is in a portfolio, it averages you out to 27, 30% returns on the portfolio annualized, which is an amazing return. And really, how those the venture capital investors really how they make their money is on that portfolio return. So going to talk about that in the Q&A if there's any other questions on those. But I want to get started here. I see a lot of great people from the Bowtie Nation here in the in the chat. So thank you for being here again. Real quick, last couple of videos last week, I wanted to point out getting into earnings surprises or earnings for the third quarter last week and this week. Last week it was a lot of the bank names. This week it'll be a lot of the tech names and a lot of the big box retailers, things like that. So be watching for that. Third quarter earnings could be the big turning point of the year, whether higher or lower, because beyond the news, beyond the stimulus, beyond the vaccines, beyond all the other things that are affecting the market, it really has to come down to fundamentals, and it has to come down to those earnings. So really, what we hear from the companies about third quarter and looking forward to fourth quarter and next year is really going to be important. So Wednesday we did a video on possible earnings surprises, 5 stocks where I think could surprise on the upside. So if you didn't catch that one, make sure you check that out. Next week, we are starting our 2021 portfolio tomorrow, and got a couple of other really cool videos coming at you tomorrow. A little early to start thinking about 2021? No, because right now I think there are so many catalysts in the market that you want to be positioned ahead of your 2021 stock picks of what you think is going to do well next year. So we're going to start talking about that. Going to put together a portfolio tomorrow. And really cool, really excited about this one because I've got a way to for you to track the portfolio and follow it and get those updates before I even do a video. So anytime I buy or sell a stock in the portfolio, you're going to be able to see when that happens without, before I add it to a video. So I want to get started now. Again, we'll have a question and answer after we do the topic here of when to sell. So if you've got a question, ask it in the comments there. Make sure you add a question mark there so I know it's a question. But getting to this topic about, when to sell a stock, and it's a question I get all the time. And it is so important, and not just for traders. Again, short-term day traders or even shorter-term traders, you're going to have your buy points and your sell points and your charting and know pretty much when you want to get out of a stock, when you want to take that profit. But it's also important for you longer-term investors, okay? Because all you have to do is look for some great companies like General Electric, Research in Motion, companies that really dominated their field at one point, and sky-high stocks that pretty much fell from above, right? I hold GE shares. I have for a couple of years now. Right around 750, maybe a little bit lower price per share. I think it could go much higher, and I'm bullish on the stock. But anybody that's been in the long term, for the long term, over the 5-10 years, you know how important it is to know when to sell a stock, okay? Because those shares of GE have come down, out of the stratosphere, and you're likely never to get some of that money back. Same thing with Research in Motion. Used to dominate the smartphone space, and fell so hard so quickly that you just can't plan on holding a stock forever. You need to have a plan for when to sell if you're going to sell a stock. So I want to cover 5 reasons that you can look for to when to sell a stock. 5 reasons that will clue you into maybe something worse at the company, something in the company's future that you might want to sell. And I'm only going to cover really kind of the highlights here of these 5 reasons. I've actually pinned a comment. The first comment below is going to be to a longer 11-minute video that I did on the subject. Gives you stepping points and really the detail in what to look for in these 5 reasons. So I just want to cover the basics here of these 5 reasons. Link to that video if you want to check that out. Check that out, and then I want to get to the Q&A because I really love talking to everybody here in the chat. It's really why I do these Beer Money Sundays. And actually, I started early, so grab your favorite beverage of choice and let's get started here. So one thing you'll notice here in these 5 reasons is they're not necessarily tied to price. Okay, a lot of people ask me, okay, a stock has fallen certain percentage from the peak. Should I sell now? Well, it's really not the fact that it's fallen. It's what's behind that fact. Why has it fallen? What is the company doing to address that? And a lot of times when a stock falls, especially one that falls so quickly, 20-30% in a day over bad news or something, then people get that knee-jerk reaction and they rush in to sell. Well, the problem is, okay, you know what? That information's already built into the stock price, okay? Unless you are a hyper-fast algorithmic trader, high-frequency trader that's got some of that AI and some of those other, the quick data, at your fingertips, and you're at your computer, all day during market hours, you're not going to be able to get out before that information is in that stock. So don't think that, okay, some news came out and I'm gonna sell it before all that news gets baked in, because it's almost instantaneously. What you need to do is analyze how that news affects the long-term view of the company and what it does to your investment thesis and some of these other 5 reasons. So we'll start off with if there's a scandal or a major lawsuit in a company. Obviously this is something like the Wells Fargo thing that happened a few years ago now, with having their people, their customer service people push people into loans and filling out fake loan applications, stuff like that. And it's not necessarily the scandal itself, but the accountability afterwards, what the company does with that afterwards. Okay, if there's no accountability at the top, so None of the management gets fired, or none of the directors get fired, or anything like that. If there's no accountability and the company really doesn't address the problem of why this happened, the compensation and the rewards packages that pushed this scandal, pushed the actions behind the scandal, then they really didn't fix anything, right? And it's just going to happen again. And eventually they're going to get hit with another scandal, and you're going to get hit again. What you'll see a lot of times is, after these major news events hits, these scandals and other things that'll hit a stock, then yeah, you get that huge rush to sell. It'll push the shares down. But then, the shares bounce back a little bit, whether, it's the next day, the next week, or just gradually over a period. So the thing is, though, if there's no accountability at the top after these scandals or after these major lawsuits or something, then it's just something that's going to reoccur, and eventually, the company's going to be bankrupt, right? So while you might bounce back on your shares a little bit after the news of that scandal, if nothing happens to fix that culture within the company, then you'll ultimately never be able to get back to where you were. And I want to point out, this isn't talking about a lot of those spammy lawsuits that you see. So anybody that, especially on Yahoo Finance, right? If you scroll through the news feed on a company for Yahoo Finance, then it is just rife. Almost every company is rife with, impending class action lawsuit and, deadline to file for this class action lawsuit, right? A lot of these, they're just spammy lawsuits. Okay, there are actual law firms out there that make their living on these class action lawsuits, right? And if you follow these, the news for long enough, you'll see the same law firm come up over and over again in different lawsuits on different companies. And it's not saying that the company hasn't done anything wrong, but a lot of times it's, when a stock comes down, when its share prices come down, and of course investors want to blame somebody. So these just piece of shit law firms, okay, excuse me, but that's a lot of what they are. They come out of the woodwork preying on investors, right? They try to get enough of investors to sign this class action lawsuit against the company. There's really nothing wrong the company did a lot of times. Maybe it's just a loss of a business partnership, or, whatever caused the stock price to go down. It wasn't management negligence. But that law firm knows that it can prey on those investors, their need to blame somebody, sign them up, approach the company with this lawsuit, this class action lawsuit, and get a settlement. Basically, that's all this is a lot of those is just trying to get a settlement to line the lawyers' pockets. The investors actually very usually, broadly get nothing almost. So we're not talking about those kinds of spammy lawsuits, because frankly, most of them are never even settled. Okay, they never even go to court, never are settled, because that's the way the game is. These law firms, they're just spam, chop shops that want to try to sue everybody and get a settlement, and the companies are wise to it, so they know that they'll drop the lawsuit when the company doesn't settle. So anyway, scandal or major lawsuit, no accountability afterwards. That's your first reason there. Next is going to be something like a debt-fueled buying binge, right? Over the past 10 years, it's been really common because we've seen this low revenue growth environment, right? With the economy only growing maybe 2% a year, it's very hard for companies to grow that top line revenue, that top line sales, right? So what's happened is they've built into this acquisition strategy, right? And they're trying to acquire growth. And what they do is also with interest rates so low, interest rates next to zero, then it's cheap, just load up on a ton of debt to buy these other companies. And basically they're just buying sales growth, okay? And one, it's just an excuse for poor management. Okay, so this is why I always say, when you're looking at different stocks, you always need to compare those stocks against the same companies or against other companies in that same industry, right? And compare that sales growth. Why is one company able to grow its sales without acquisitions? Why is it able to grow its sales at one percentage, at a certain percent, and another company can't seem to make any sales growth, right? So what a lot of times will happen is this company that's got maybe the weaker management, can't grow that sales growth in that lower growth environment, uses acquisition strategies as an excuse. So again, one, it covers up for poor management, but two, they're taking on so much debt that eventually that debt's going to come up to bite them in the ass, right? they make an acquisition that is just too large, or the sum total of all those acquisitions just kind of builds up on the books. They never get the kind of profits or the kind of earnings out of it they thought they would, and the interest expense builds up until basically they have to file bankruptcy. So another one, something to look for in your companies: if they start going on a debt-fueled buying binge, it might be time to reassess your investment in them. It doesn't mean that acquisition strategy isn't something that can grow a company, but you have to make sure that it's not an excuse for poor management and that debt isn't getting out of hand. Okay, they're making these acquisitions, and they're actually able to turn that into into better fundamentals over the long run as well. Number 3 here, when investors really lose faith in the management. Okay, and so this is kind of tied to that first one with the major lawsuit or a scandal, and you'll see this is kind of a recurring theme here. A lot of this is going to be about management, right, and how management is running that company. It's not necessarily how the stock does from quarter to quarter. It's that longer term trend of how management is helping to grow the business. And some of the things you can look for in this part, in this one, as far as investors losing faith in management, is, are they regularly missing expectations? Okay, a big job of management, and it kind of sucks. It's kind of the argument for doing biannual earnings releases like they do in a lot of other countries, or even even going private. A lot of companies will go private because of this, because a big part of management's job and a lot of stress on management is those expectations, those quarterly expectations. They have to manage what investors think they're going to earn every quarter, and then they've got to beat it, right? Because the vast majority, I think it's something like 73% of companies actually beat earnings expectations each quarter, right? And of course, if you don't beat expectations, if you don't beat what the Wall Street is expecting your earnings to be, then your stock is punished because for some reason, supposedly you didn't do anything right, and you didn't grow beyond what was expected of the company. And it's all kind of a farce, right? Management massages those expectations ahead of earnings so they can then beat it later. A lot of companies are very adept at doing this. Apple is one of the best. Apple's management is one of the best at doing this. It just historically, an amazing track record for beating expectations. And it's because, you watch some of the news flow out of management ahead of time, and as well as the outlook they provide during their earnings releases, and they're managing those expectations, And so it's kind of a game, but if management can't play that game, if they're not able to play that game, then investors are going to lose faith. They're going to lose faith that the management isn't able to manage those expectations. Also, constantly underperforming on the operating margin or other ratios. And again, you can just compare that company with other companies in that same industry and say, okay, why is company A, the operating margin, they're able to get 30% to convert 30% of their sales into operating profits, whereas at this company, perennially, they're only able to convert maybe 10% or 15% of sales into operating profits. And again, quarter to quarter isn't that big of a deal. Maybe company specific stuff, but ongoing, long term, if a company isn't able to raise its operating margin, some of these other ratios to the average in the industry, then it's a problem. It's a problem with management, right? Because they're both selling relatively same products. In that industry, they're still selling similar products. And it's management's job to be able to take that product and really get more out of it in terms of sales and earnings. So again, when investors lose faith in management, that they're able to manage these earnings expectations, beat those earnings expectations, constantly underperforming on some of these ratios that we talk about here on the channel, like the operating margin, like gross margin, things like that. The fourth reason you might consider, just shares at a fair value. Whenever you make an investment, you need to kind of put a fair value on the shares, right? And that means a short-term and a long-term fair value estimate. Okay, you can be a long-term investor and still have a fair value idea of the stock. Okay, and then maybe once a year you update that fair value, so it's not like you're trading out of your stocks anytime they get any kind of a big a big bump. You're still doing that analysis on the stock to see, okay, maybe is the fair value maybe a little bit higher now because they did sign on this partner that led to a big bump in the shares. So you constantly need to be, reevaluating where you want to be on these stocks and what's a good value. Because, if you buy a stock primarily because it's a value stock, then even if you're a long-term investor, shouldn't it stand to reason that, if those shares come up and it's doesn't meet those criteria for a value stock anymore, then you should sell it, right? I mean, that just stands to reason. But I see a lot of long-term investors, they get into something primarily because it's a value stock. Maybe they like the company, they like the brand marginally, but mostly it's because of that value estimate. The shares come up, they don't sell, and it's just kind of dead money after that. So you definitely need some kind of an idea of fair value. That doesn't mean you can't raise your fair value opinion regularly. Maybe every 3 months you look at your stocks and reassess that fair value, or maybe every year, and you think about that. Last here is just a fundamental change in the outlook, right? One of the biggest reasons you should be investing in a stock is because the company has a competitive advantage or some kind of a best of breed status over its peers, okay? And competitive advantage can come from its brand, right? So, Coca-Cola has spent billions, hundreds of billions, I probably over the decades to create this brand, and that means something that carries a lot of weight. People pick up a Coca-Cola just because of that brand and what it makes them feel. So it can come from a brand. It can come from other advantages, like leading edge technology in a company. It can come from first movers advantage. If a company is the first out with a way to do something, like a lot of the stocks we've been looking at this year, some of those first mover tech companies like Fastly, that's moving, using a lot of their tech advantage in that streaming service that they have. The Zscaler is a big one, where it's providing that cloud security platform that is taking a lot of the business away from some of the legacy providers that are still dependent on hardware security. So when companies have that first movers advantage, that's a competitive advantage, because they can bring customers in on that first movers advantage, and then keep them there and really turn that into a long-term business profitability. So you've got those competitive advantages, best of breed status in a company, whether it's from just economies of scale or a company's dominance in the market. But if something changes, then you really need to reassess why you're investing in that stock, right? So if Zscaler, with their first movers advantage, if another company comes out with a bigger and better way to provide corporate security, digital security, comes out with the next tech, and then Zscaler doesn't have anything to answer to that, right? It's going to lose that competitive advantage, and you really have to reassess. Is Zscaler still a good long-term company, right? So those are really the 5 reasons that I look for when I'm thinking about whether I'm holding my stocks for the longer term, or whether I need to reassess why I'm investing in that company. And again, notice that falling stock price was not in that list. If nothing else, we were thinking about selling out of a company when they reach that fair value, when the stock price goes up. That's when I start thinking about whether I should still invest in a company. So falling stock price, a lot of times whatever news caused that stock price to come down, it's already priced in. And it's not to say that you should just ignore these falling stock prices in a stock, but your job now is to take all of that in, decide if that stock is still worth investing in right now with this new information. How does that change your fundamental outlook in the company? Its competitive advantage, how management is running the company, whether there's going to be any accountability for whatever this news was, whether it's a scandal, a lawsuit, or just some kind of a general business problem. Okay. So again, 5 real quick reasons right there. Just kind of the overview on each. If you want the detail in each of those, look for in the comments section below. I linked the video with the detail, a little bit longer video, the detail on each of those 5 reasons, when to sell out of a stock. Now I want to to get to the question and answer here. Again, I'm going to try picking out some of the questions that were already asked. If you got a question, just go ahead and ask it again in the comments below. As we get closer to the election, I see more and more political commentary in the in the chat, and that's not what we're here for. Okay, so let's keep it let's keep it investing. What else? AT&T, should I buy the dip? I mean, I've been bearish on AT&T for a while. For a little bit there, it was a nice stock trade, and I got in it, and I still think, I mean, it can be an okay company, but they just don't strike me as a leader in anything they do, right? I mean, if you're looking for a pure play telecom company, and I like telecom right now because of 5G and a lot of that other stuff. I mean, I think you can go with some of the other ones, maybe Verizon or some of the other pure play companies there. AT&T, it's just in so many business lines. I think streaming, it's really not doing as well streaming versus competitors like Disney and Netflix. So it's kind of falling behind there. It's spending a lot of money on content. With Dish, I think they actually were talking about spinning off or selling their Dish business finally, because it just hasn't worked over the years since they've acquired it. And I think with AT&T, you run into a lot of that acquisition strategy. They just started acquiring as much as they could and put on so much debt that it's really started now to become a problem. So I think there's better stocks out there, better companies out there than you can buy versus AT&T. It's got a nice yield, and they've been good about growing the dividend payment to keep that yield higher. So it's not a quick sell. It's not something you have to rush out and sell. And if you see something in the management and in the company, then hold on to it for by all means. But I'm probably not investing more in AT&T right now. What else? Trying to find what is the best commodities ETF out there. August Portfolio, what is the best commodities ETF out there? I mean, I really couldn't tell you right off the top of my head. I mean, I don't know if I would invest in a whole commodities ETF. I would rather do the individual metals in ETFs. So you've got like the iShares Silver, which is SLV. You've got the Spider Gold ETF, which is GLD, which are just going to give you direct access into or direct exposure to those prices. You might also try the copper ETF, and that one, the name escapes me for the copper ETF. Let me see if I can find it here real quick. Whoops. Okay. So yeah, I mean, I would go with the pure play ones instead of an all around commodities ETF. I know the U.S. Copper Index Fund is popular, and that ticker is the CPER. It's a little bit more expensive than some of the other pure play commodities ETFs. So look for that if you're trying to position in copper for growth. Now, copper is obviously much more of an industrial metal versus gold or silver. So you would have to have a good outlook for industrial growth, global economic growth. You might try also some of the ETFs for commodities, farm commodities. Some of those I know, MOO, ticker MOO, is a good agricultural commodity ETF, and that's one that I actually do like. I know there's corn, which is CORN, is another agricultural ETF. I would go with those if you're looking at agriculture, or the pure play metals ones if you're looking at metals. So the GLD, the SLV, or one of the pure play copper ETFs, rather than just general copper or general commodities experience or exposure. Now, I do like commodities over the next few years, just on that idea of maybe higher inflation and higher government spending and that kind of thing. Uh, so, and what else do we have? All investors are not traders, but use tech analysis to determine. Cat L wants to know about technical analysis. There's are some traders here, but mostly that longer term investors, buy and hold investors, that kind of thing. Technical analysis is mostly chart watching, right? You're following the charts, the price patterns, and things like that. And I'll do this occasionally. It's mostly on the idea of valuation, right? And so you get that relative strength indicator where I'm trying to find stocks that have come down and maybe are short-term cheap. You've got other ones with the on-balance volume. The OBV is another really good technical indicator to follow. And basically, this just takes volume into account as well as those stock price moves, right? So a lot of times when you see a stock move, whether it's higher or lower, if it's on very low volume, so not very many investors in that, then it's really not much of conviction. But what this on-balance volume does, it takes that volume into account. And so you're looking for stocks that whether bigger moves on the upside or on the low side, and the commensurate volume spike as well. So a lot of conviction in that move. So I'll use that occasionally as well. But if you're going to be a long-term investor, then it's okay. I'll look for these short-term, short-term indicators as to whether I should, get into this stock now or maybe wait and watch the fundamentals a little bit longer. But generally, you're looking at those longer term ratios and fundamental factors. So, you can spend a lot of time doing this. If I were to drop one thing from my process, to free up a little bit more time, it would be that technical analysis, right? Because you're really analyzing a stock for the long term, for that long term investment, and what it's doing, from quarter to quarter probably isn't quite as important if you're talking about long term investing. What else? What are some of the best long term hold stocks to look out for? A lot of that's going to depend on what you already have in your portfolio. A lot of times, the best investments are just what fill out the gaps in your portfolio. Okay. Now I can preview real quick what some of the things we're adding to the portfolio tomorrow for our 2021 portfolio. So kind of a preview here. I know we're putting I'm putting Citigroup in there, which might kind of surprise a lot of you as far as kind of long-term buy and hold investments, because it's not necessarily a growth stock, right? It's a very extremely old company in a very mature industry, mature sector. But and what I explained tomorrow in that video is really the two sectors that I'm looking at for amazing, excellent entry points into a long-term portfolio. So Citigroup, I think the financials have really been hit hard, especially over the last week as those bank earnings came out, and I think it's overdone. I think if you're looking for one industry that really isn't doing that badly, and will rebound eventually and will make for great long-term returns, I think it's the financials. I think it's a lot of those bank stocks, and so I'm getting in Citigroup. For that, look, banks just aren't making any money right now, and with those rates where they are, right? But they're not in fundamentally bad shape. Okay, we're not looking at 2008 where the banks have a lot of distressed loans, a lot of bad loans on their portfolios. Yeah, the more commercial banks out there that are more, have more of their business in commercial loans, they're going to have some loan defaults, but they're putting tens of billions of dollars into that. Just the top four banks have like $40 billion in loan loss reserves waiting for those loan defaults to come up. So one, they've already prepared for it. Two, if the economy keeps on growing and we get more stimulus and more handouts from the government, frankly, is what it is, then those loan defaults may never happen, and they can move that money back onto their income statements, and it's going to be a very good year, I think. Even if they don't rebound immediately in 2021, the financials, I think, is definitely one you can start putting your money in right now into some of these best banks, these biggest largest banks, and you're going to be doing very well over the long term. Another one that we're that we're investing in here. FANG, FANG. It's Diamondback Energy, and this is one we kind of highlighted last week. But strong energy company, and another sector where I think you can get in now. It's a great value play, and it will rebound. Okay. You look for these energy companies, these explorers that can survive, at this $40 a barrel oil, right? Because oil will come back up. It's going to be at least 5 to 10 years before we really get that electric vehicle revolution that pushes out the demand for oil. So I think a lot of these explorers that are down 50% plus from their peaks, they can be very good long-term 3 to 5 year investments at least. What else do we have? Somebody asked, I know somebody asked so Eric asked who else is worried about a stock market crash. Now, I mean, I've been first to sound the warning bell, sound the alarm on the market. It is so expensive right now, with the exception of a few of those sectors like the financials, like energy, like healthcare is actually pretty cheap right now as well. But beyond that, the market is extremely expensive. I'm not chasing stocks in a lot of those sectors, tech stocks, and that because I don't need to. I don't need to try to get that extra 3% return if I have to invest in a stock that's trading at like 40 or 50 times its PE ratio. And the economy is not nearly as great as the market makes it out to be, I think. We've still got 900,000 people filing new unemployment claims every week. Now that's not people that were laid off, in March or April when we had that complete lockdown. These are new unemployment claims, companies that are laying off people right now because of the economy. We've still got, what is it, like 8.4%, 7.9% unemployment rate. The real unemployment rate, when you include this discouraged workers and a lot of this other workforce, is much higher. So yeah, I don't think the economy is doing well at all right now, and does not justify these prices. Now, why I am a net long investor, though, why I'm more bullish on the stock market over the short term, though, is because right now it's really not about the economy. The market is singularly focused on a vaccine, right? A vaccine approval, stimulus, and in some part to the election. And the market's only looking at the election in terms of stimulus, right? The market right now is pricing in, whether you like it or not, whether you believe the polls or not, the market is pricing in a Democratic sweep in November, right? That would be presidency, Senate, and they already control the House, right? And like it or not, Republican or not, whatever, the Democrats typically spend more money. They're for more government spending. They've been pushing for higher stimulus. The Democrats rolled out in May their $3.4 trillion plan. They brought it down just last month into like a $2.2 trillion plan to be closer to the Republican plan for that negotiation. But if we get a clean sweep in November, then we might get another $2 trillion in stimulus. And whether it's actually going to help people or revive the economy, you can argue all you want about that, but it undeniably pushes asset prices up, right? So the market is looking for that, looking for that extra stimulus, pricing that into stocks right now, and that's holding it up. I know Pfizer said last week that it was going to be seeking emergency authorization for its coronavirus vaccine around late November, right? And there are so many companies in this vaccine race that we will get a vaccine approved probably on emergency authorization in November. Late after, it'll be after the election, but it'll be either November, December, and that'll be a big boost to sentiment. Okay, so the market is looking at those two, and it's saying, okay, you know what? Yeah, the economy sucks right now. Yeah, stocks are extremely expensive right now, but we've got these two huge sentiment boosts. We've got this money flowing into the economy. The Fed is keeping rates extremely low. Never gonna raise rates, basically, is what the Fed's saying. And that's gonna keep a floor under stocks, right? So I do believe, through November, December, maybe even into January or so, then you're gonna have that floor of support under stocks that is going to keep stocks from coming down too much. Could we get a 5 or a 10% correction? Yeah, of course we could, because stocks are so expensive right now. But there's going to be that floor of support. So I would be a net long at least over the next 3 months, 3 to 4 months. Longer out from that, though, I am looking at probably February. And obviously it's hard to say, month to month, any specific month when it could happen. But there will be a point where the market's going to look and say, okay, we've got our stimulus, we've got a vaccine, but the economy still sucks, right? We're still fairly high unemployment. Unemployment hasn't yet trickled down into retail sales and consumer spending, and that's really the big shoe to drop, right? But you can't have, retail sales for last month came out this week, and they were way above expectations. It was a big market mover and big surprise, but you're not going to have that going forward. Okay, if we get more stimulus, then yeah, it prolongs it a little bit, but you cannot have 7-8% unemployment, U3 unemployment, or even 10% plus unemployment on some of those other measures, the U6 and such. You can't have that and still have high consumer spending. It's just not going to happen, right? So there's going to come a point where we've got all these big, these big catalysts, the vaccine, the stimulus. You've already got those in the market. They're already done. And the market's looking for something else. And all they're seeing is the economy that isn't in the best of shape and doesn't justify these record high prices. And that's when, before that. So, I'm thinking February, late January, February, March is when this market actually starts pricing some of that pessimism into prices. So again, I'd probably be net long, bullish through the next few months. I think the stock market can do well with that floor of support. But then, I definitely want to reassess where I think the market is, in January of next year, and be positioned for that, be ready for that. What else do we have? Bought some gold and silver. Like I said, I think I do like the commodities here, just if nothing else for that real assets and that inflation trade over the next few years. Like I said, the Fed has committed to not raising rates for several years. The economy is basically, I think last income report, they said something like a third of household incomes was being supported by that stimulus. The stimulus is holding it up and pushing prices out there. Jean Fritz, Jean St. Paul wants to know about CVS, low operating margin, but other points are solid in his position. Wants to know what I think of CVS. I love CVS. Those of you in the nation probably get tired of hearing me talk about CVS in some of the videos. And in fact, tomorrow's video on our 2021 portfolio is going to include CVS. So a little bit of a spoiler alert there. But yeah, CVS, they haven't done well over the last couple of years. So it's been a tough call. I just started my position probably about 4 or 5 months ago, that I started going long into the stock. So, hoping it gets into a turnaround story. And I think there's a lot of reasons to be in it for the short term, but especially for the long term. Okay. Healthcare is a major factor of all of our lives, and only getting more important as more people age into that demographically important part of healthcare spending. But more so CVS, they've been building this just giant healthcare distribution network for about 10 years. They've got Aetna for the insurance. They've got Scripps, I think it is, right? Or Caremark, I think is the other, is the pharmacy benefits company that they acquired a few years ago. They've obviously got more than 10,000 stores, so a huge retail network for pharmacy and all that. Just an all-encompassing, controlling healthcare distribution network that they're going to be able to use to really grow profits. What I've really been looking for, and what I'm frankly kind of surprised they didn't get a bigger bump, was I think it was either Thursday or Friday, the news came out that the administration is actually working with CVS and with Walgreens to distribute the coronavirus vaccine when it comes out. So some of the first real partnerships, real vaccine distribution partnerships that we've heard about went to CVS and Walgreens. And actually, if you look at some of the videos I've done about CVS over the last couple of months, that's really been a big part of my thesis. Is they've got this huge distribution network. They can reach anyone and everyone. They are primed to be able to distribute that vaccine like no other company. And I think it's going to be a major upside, a surprise upside, evidently from the share price perspective, because we got the news come out, and I think it was up 2-3% maybe, which isn't really a big move for CVS, but I think it should be much higher, and I do think it's going to be much higher over the longer term. What else? Okay. One wants to look at DOCRF. Really haven't looked at it from the looks of it. It's probably maybe a penny stock, I would say. So a very, very small cap stock. Haven't looked at it. I'll have to look at that maybe a little bit later. So what else? Walgreens Boots Alliance. So yeah, that's another one. And I think somebody said, Juan Wei said feeling like they're setting up to be bought out. That would be tough, but I could see it happening. Amazon is obviously trying to corner the market on healthcare, so I wouldn't be surprised maybe if Amazon does go after a distribution network like something like that. I haven't looked at Walgreens as far as the debt load and some of that other stuff, so it would have to make sense as far as how much debt they have on the books, how much of that problem that another company would have to pay to acquire it, or the valuation. I haven't looked at that as well, obviously, but yeah, I mean, with the thing is with interest rates as low as they are right now, then it just makes sense for companies to load up on the debt and make that acquisition if they think they can acquire some growth into a sector of the market that they want to be in. So, and that's why you're seeing a lot of acquisitions now, in the space. Capital gain tax. Okay, so Mark has a great question here. Could be a sizable pull out of the market by the end of the year. $1 million investors if the Democrats win, and looking at that capital gains tax increase. Now, okay, so Biden has come out with his tax proposals, right? And it does include raising the corporate income tax from 21 to 28%. Now, remember, it came down from like 35%. So it's really not a huge tax increase on corporations. He has talked about the capital gains increase. But again, it's probably going to be at the very high segment. So 400,000 a year people, millionaires like you talk about. Now the thing is, one is I don't think the reason why I don't think it's going to happen by year end if he wins, because nobody's going to be increasing taxes next year. Okay, it just ain't going to happen. I mean, you don't raise taxes in when unemployment is at 7 or 8%, right? You don't raise taxes at the same time you're pushing stimulus out there for PPP loans and other stimulus to try to bolster the economy, because they just cancel each other out, right? And plus it would be political suicide. Okay, even the Democrats in Congress would just mass exodus out of the camp there if there was a serious push to raise taxes even next year. I could see maybe towards the fourth quarter of next year starting to talk about it, but certainly not even in the first half of the year, not even talking about raising taxes. So I don't think the market's going to be really worried about that, and I'm not worried about any of those tax increases either. Even though I am in that, would be probably paying higher capital gains taxes if they do go through with that. I think it's like a 400,000 and above income range. But it's just not going to happen. Not when unemployment's where it's at, not when the economy's where it's at. Somebody, Zuli, wants to know about Square for the longer term. I do like Square. I've highlighted it before. Haven't looked at it in probably a couple of months though. I mean, it's a payment system, and payment systems are big, obviously, especially over the last few months. I don't know where the valuation is right now, so I would hesitate because most of these tech stocks are just extremely expensive on a valuation basis. I think you can wait for maybe that sell off into February, March, April, somewhere around there, and probably get it at a better price. And honestly, if we do get more stimulus, we get a vaccine, and as we move on to some normality next year, then you're going to see that rotation. Okay, you're going to see the rotation from growth, where the market's been this year. Those growth stocks, tech stocks, a lot of the best performers this year, into value, which are again, is why I'm looking at energies and why I'm looking at healthcare and financials a lot for next year, because you get that rotation every once in a while in the market, where investors just kind of naturally shift to one segment of the market, right? And growth has been doing very well, but it is so expensive right now, and I think a lot of your value names is where the money's going to be going to, mostly just from consumer spending standpoint. Okay, people aren't going to need the maybe some of the work from home technologies quite as much next year. So a lot of those revenues are going to come down and disappoint the market, I think. So investors are going to be looking for where else to put their money in. They're going to find it in growth. So I would be, someone else, Prigler, asked about dropbacks, Slack technology. I like these companies for long-term plays. Square, Slack, and Dropbox. They're great long-term ideas as as our world shifts to more being more online. But right now, a lot of them are extremely expensive, and there you will get that rotation out of those names, I think, next year. So I say put them on your watch list. If you really, really love them, and if you think the valuation is perfect right now, maybe pick up some shares, maybe pick up a small amount just to make sure that it's there in your portfolio and you're watching it. But I would say hold off on any big purchases for a while. What else do we have? REITs, highly undervalued. REITs are tough. REITs are. REITs, I love real estate. It's where I got my professional start as a commercial property analyst, and I've worked as a REIT analyst for a while. But again, with REITs, you got to talk about it in sectors, in property types. You can't talk about the entire REIT market, because within that, you've got the digital REITs, the data centers, and that the wireless towers, right, that are doing very well, obviously. But then on the other side of the spectrum, you've got other property types like office, like retail, those. Shopping malls, things like that are obviously doing very poorly, and there's a reason for that. So if you're looking now, I assume when you talk about value in REITs, you're talking about those that have underperformed, the shopping malls, the retail, and the office. And I think it's dangerous. I would say over the next couple of months, especially as that vaccine comes out, is approved, and as we get more stimulus, and you could get a bounce in these, especially the retail and the shopping mall ones. SPG, some of those. I actually like Macerich a little bit better than SPG, just because it's a little bit better quality malls that Macerich owns. So you could get a big bump over the next couple of months, but longer term, these malls and the retailers are in trouble. Okay. On one part, you've got that long cyclical structural change from traditional shopping to online. Okay, and it's just an undeniable, unstoppable force that is driving that up. This year accelerated it because of the virus, but it's just going to keep on going. So retailers are going to be struggling for decades with that shift to online, right? But more so also, especially with the malls, then they're converting a lot of this space, as these big box retailers like JCPenney, like Sears drop out, they're converting a lot of that space to warehouse. I think SPG was talking to Amazon about leasing a lot of its space for distribution centers. Well, the problem is people don't go to the mall to look at the Amazon distribution center, okay? And that's what these big box retailers used to be. They used to be magnets, traffic magnets for these malls. So, if you convert too much of your mall to a warehouse, to a distribution center, then it just becomes an industrial property, right? Actually, I think it was the Wall Street Journal last week, put out a piece, maybe it was Bloomberg, about the effect of changing the property type in your malls, in these malls, to these other warehouse and storage and whatnot. And they said, you drop the value down by, minimum like 60% of these, just because, retail lease rents are so much higher than warehouse, distribution, that kind of thing. So, what you're going to get is a lot of these. I think you're going to get SPG, even Macerich, which owns better quality malls, but even Macerich, they're going to have to write down a lot of value over the next couple of years. Okay. And I think that's really going to be the next shoe to drop for the malls, for the mall REITs, is going to be, writing down the value of those malls when they figure, okay, well, you know what, instead of JCPenney's, now we got an Amazon distribution center in that mall. So we're not getting the rents we used to be getting from a lot of these other retailers. We're certainly not getting it from Amazon. So that mall just isn't as attractive or as valuable right now. So I would be very wary of some of these malls, these retailers, as well as some of the other those REITs that have been doing poorly. What else? What else do we have? I think of buying a little Bitcoin to assimilate for the future. Another question by Mark. Great questions. Love it. What about buying a little bit of Bitcoin for the future? And, I don't like Bitcoin at this price, and I'm not a Bitcoin expert, but I have been in and out of Bitcoin in the past. I like Bitcoin more, and I think I talked about this last week with the weight of value Bitcoin, and I want to look that up because I couldn't remember what it was called. Social theory, social valuation theory, Bitcoin users. See if we can find what that theory is for Metcalfe's law. Okay, if you're investing in Bitcoin, look at Metcalfe's law. Okay, and it's a little heady mathematically, but it's not too difficult. But what Metcalfe's law says is the value of any social network. Okay, and that applies to Facebook, Twitter, a lot of these social media stocks, but it also applies to Bitcoin because its business is, this business depends on that basically that network of users. Okay, and Metcalfe's law says that any network of users, any company that is based on a network of users can be valued off of that. Okay, and it's going to give you kind of a floor price, a support price, a fair value for Bitcoin. And what it says right now, it's actually only right around maybe $4,000 to $5,000 for a fair value. Now, of course, that doesn't mean that Bitcoin can't go higher up in price on, maybe a little bit of a hype or investor value, investor sentiment. But really, that's where I like Bitcoin at, is down there. I know it hasn't been there in a while, and that's why I haven't invested in Bitcoin for a while. But generally, when it does fall down between 4 or 5, even, into the mid $5,000 per Bitcoin, I'll pick up some Bitcoin and then sell it out when it's 8, 9, 10,000 per Bitcoin. Can it go higher in the future? Sure, it can. It's the whole idea behind it, the distributed network and everything. It's a great idea, and I think it is the future of a lot of different sectors and industries. But I don't know that it's a great trading strategy. Or a great long-term thing if you're in it at 10 or 15,000, it might be a very long time to wait for it to have any kind of a return or a gain. So with a lot of these these high risk, high return, these long shot, moonshot investments, what I say is, and the penny stocks that we talk about on the channel, what I say is that, put maybe, total 10% of all your wealth in these. So maybe 2 or 3% in any single one. So, you've got maybe 2 or 3% of your money in Bitcoin. Maybe you've got 2 or 3% of your money in a certain penny stock, or in a group of 5 penny stocks. Maybe you have 5% total, right? And the idea here isn't that isn't that you're going to get rich off of them, but you're going to get enough of that moonshot return on just a couple of these that it's going to juice your portfolio for maybe another 5-10% portfolio return on top of your other stock picks. So I wouldn't be going into it with 20 or 30% of my money, but I think it can be a small part of your alternative investment part of your portfolio. It's been about an hour. I'm gonna close it off from there. I gotta go lift. Actually, started just getting back to the gym. It's opened up down here, so loving being able to do that. Thank you again for everybody that's been here today. I love having these conversations with you. Again, next week, Sunday at 2 p.m. Eastern Time, 11 a.m. Pacific. I'll be right back here talking about something else. So if I didn't get to your question, ask it in the comments below. The video usually takes about 30 minutes to process, gets up on YouTube, and you can ask your questions there in the comments. So thank you again. I will see you tomorrow for tomorrow's video.